Hello and welcome to Big Deal. I'm Nisha Poddar. Now, the investor industry body IVCA, or Indian Venture and Alternate Capital Association, has been, remember, tirelessly working on boosting the investment climate in the country. Now, we have with us the newly elected leadership team to talk about the investment climate in the country and also the efforts and solutions needed to really build more momentum here. Let me welcome on the show Ashley Menezes, who's the partner and CEO of ChrysCapital and also the newly elected chairperson of IVCA. And with him is also joining Srini Sriniwasan, who's the managing director of Kotak Alternate Asset Managers, and he has also been elected the new vice chairperson at IVCA. Gentlemen, so good to have you on CNBC-TV18. Now, my first question to you, Ashley, as somebody who has been investing in the country for a very long time and been part of IVCA, what will be on top of your agenda to soothe the investor climate in the country and also to bring in ease of investing here?
Thank you, Nisha, for having us on the show. I think, the IVCA has been pretty active for the past many years in promoting the investment environment in India. And broadly, the intent will be to continue to do that. I think there are a few things that we're thinking about in terms of what we should do over the next 2 years. But prime of that would be, is there a way to boost the ecosystem for domestic capital? Hitherto, we have had most of the capital that's coming in through private equity in India being foreign money. So the biggest challenge that we will have is how do you encourage more domestic pools of capital to sort of come into play with the overall plan and ideals of Atmanirbhar Bharat. Can we work towards that? We also have other aspects that are secondary, but this is the primary objective.
All right. So, Ashley, you touched upon a very important point, and a lot of efforts have been made by IVCA towards boosting the domestic pools of capital over the years in some of the agenda that you have taken up with the government also. And Fund of Funds is one great example of that, and many other efforts have been taken. Now, Srini, jump into this discussion, and I first want to congratulate you for getting a seat on the table from a non-peace side. So does that mean the focus, dynamics, and also the industry trends in terms of who brings more pool of capital is changing?
No, I think, first of all, the fact that the new leadership in IVCA is reflecting multiple asset classes, which is why the association was actually called Alternative Investment Funds. And the present set of leaders represent practically all facets of the kind of strategies that investment managers in India have been pursuing, whether it is private credit, real estate, infrastructure, venture debt. Everybody gets to have a say in how we as an industry can shape the development of this industry, can work with the regulators, can work with the policymakers to make sure that the platform for pooling capital, whether it is from global investors or from domestic investors, grows into a significant participant in our eventual goal of becoming a 5 trillion economy.
Right. A lot of capital formation for the growth of many industries has been really done by the investor class, and especially the private equity industry, not to mention the foreign participation at that. But Ashley was also mentioning about the domestic pools of capital, which is extremely critical for India to really use its own capital formation for our own growth. Srini, you want to talk about this, that where are we in that journey and what are the key challenges there?
I think if you look at the capital that has been raised by investment managers in India, as Ashley mentioned, the majority of it has come from foreign institutional investors. But over the last 5 or 7 years' time, a fair amount of money has been raised from the domestic market as well by investment managers. But the bulk of that money has come from individual family offices or private clients. The domestic institutional capital is currently yet not there in sizable amounts and numbers. And where does that capital actually lie today? It actually lies with the provident funds, the pension funds, and the insurance companies. And I think as IVCA, we have been working with the policymakers, with the respective regulators, regulating these pools of capital, getting them to understand what this asset class is about and what we can deliver for them. Today, even though they do have some allocation to alternative assets, they have actually not acted on those allocations, and they are far less actual investments than even the existing limits that they presently have. Now, this can be on account of lack of experience, lack of capacity to underwrite. I think working with the institutions, getting them familiar, building capacities to underwrite and take those decisions is something that we as IVCA have been working. The previous office bearers have been doing a great job of doing that. And I think Ashley and I will take the same thing forward and try and see how we can get these institutional pools of capital also to participate in these alternative investment strategies. Not only that, to enable to do that, I think both of us are committed to work with the regulators to make sure that institutions are comfortable in allocating capital to investment managers, and to make sure that whatever we do in terms of governance, in terms of transparency, in terms of reporting, is meeting the expectations of the policymakers and regulators.
So Ashley, where are we when we talk about the institutions participating in domestic pools of capital? What are the challenges, and where is it that the regulatory framework as well as the regulatory engagement lie at this point?
No, absolutely. So just before I jump into that question, I think if you see what's happened even on the listed equity side, the mutual funds, 5-6 years ago, stock markets were very dependent on foreign money as from in terms of their pricing. I think today with whatever it is, $2 billion of SIPs coming in every month from retail investors, another almost $1 billion coming in through national pension schemes, etc. We have been able to counter that volatility, and there is a lot more stability in the public markets. I think the concept is exactly the same here. I think the first inroads have been made through family offices, as Srini mentioned. I think the bigger thing is how do you get institutional capital to come, and that's what we've seen globally, right? Even the US or even in the rest of Asia, it's pension funds that are the largest contributors, insurance companies, etc. I think the challenges have been, how do you build and have a constructive dialogue with the regulators? So we obviously will pursue advocacy, but can it be research-driven advocacy? Can it be a constructive dialogue? Can we build a bridge to ensure that there's no trust deficit between what the regulators think and what the industry is doing? So I think that is an important facet that we want to build, so that there is clarity in terms of what are the commercial aspects that are needed by investors and by institutions to invest in funds, and how do we enable that in a positive manner, working with the regulators. So, there have been a few things that have happened. There was the Damodaran committee that gave a whole bunch of suggestions. I think we would like to take some of those things forward. We'd like to, again, as I said, have constructive dialogues with all the regulators, be it SEBI, be it RBI, IRDA, IFSC, whoever, right? I think we want to have that so that there's clarity of thought in terms of what their expectations are, and how do we as an industry also ensure that we meet those expectations. We work within the realms of the regulations. At the same time, the regulations are not limiting to prevent these pools of capital being built.
That's right. A lot of effort is also on public discourse and the opinion being created as a surround sound. But Ashley, jumping on to the private equity and the VC pool. Now, the levels of deal making and the investment have been cautious, at least in the last year. They reached the pre-pandemic levels, and we saw a huge amount of exits by the private equity. Yes, there were investments, but they were offset by the amount of exits. And there were more investors for the old economy sectors or their own portfolio companies. These are the key highlights. How do you see the private equity participation now in this particular year?
Sure. So first of all, unlike public markets, exits are actually a good thing in the private equity venture capital world, right? Remember, this is typically a 10-year product. Investors put in money and they start getting exits from year 5 to year 10. Um, our experience has been that as and when you return money to investors, that money comes back. So exits are a good thing. And one of the criticisms that India had been getting previously is that there aren't enough PE, VC exits coming out of India. Investors are only putting money in and not getting enough money out. I think that has changed. We've seen that change for a couple of reasons. One is the public markets have deepened. The IPO opportunities are a lot more. You're seeing a lot more global investors participate, and therefore a financial sponsor purchasing from another investor. Some of those possibilities have become much larger. So clearly that has helped. I think on your question in terms of is there reduction in terms of deals or in terms of the total value coming in, I think if you need to break that up into venture and private equity. On the venture side, yes, there has been a little bit of a drying up. There is a little bit of a funding winter there, where only few companies are able to raise capital. However, on the private equity side, we're actually seeing sufficient amount of deal activity there. It is at in terms of number of deals as well as in terms of sizes of deals. More importantly, we are seeing a lot more buyout type of transactions, and a buyout type of transaction, while fewer in number, actually take a lot more in terms of capital. And I think that is again a very interesting and positive trend. So if one distills that out, and the reasons for why venture funding has dried up are sort of 2 or 3 reasons. I know there have been some issues around governance in certain cases of younger companies. But the fundamental reason also has been valuations on the venture side have been very heady. And so there is some level of correction that has come through, which is what you're seeing in some of the funding situations as well. I still do believe good companies will be able to raise capital from high quality investors, regardless of whether it's a venture deal or it's a private equity deal.
Right. So that's a good summary of what is happening in the VC and the private equity investment scene right now. But there's lots more to discuss on that scenario, and also on what the investor community wants and where are the teething troubles. We'll head into a short breather on Big Deal, but we'll come back and discuss a lot more of that with the IVCA's top leadership team. Welcome back. You're watching Big Deal, and we have with us Ashley and Srini talking about the IVCA's plans going forward. Now, Srini, there are various aspects that we have discussed, but let me address the big burning question. Is the regulatory environment for the AIFs challenging in India?
No, I don't think it's challenging in India, but the regulations have evolved over time. We started off as a light touch regulatory regime. And over time, obviously, experience teaches us what needs to go right and what needs to go wrong. And regulations are born out of those experiences. And in the recent past, there have been a number of issues on which regulators have not been happy in terms of the way AIFs have conducted themselves. And therefore, new regulations have come about. Having said that, I think it's a constructive process. We are engaged with the regulator to make sure that while we want to make sure that we follow a governance path, we have already committed to the regulator that by the end of this month, we will have our code of conduct, and we will streamline all the processes and issues that investors may have faced in the past. And that's something that we are very constructively engaged with the regulator. And to my mind, I think our interactions believe that the regulator wants to make sure there's a clean market, and they're very interested in developing the market. So I think it's a very constructive dialogue, and we should be able to move forward to actually make a very robust alternative investment industry, which can give birth to multiple strategies. As we have seen, there are credit funds operating in India, real estate funds operating in India, venture debt funds operating in India, and all of these are interesting themes to follow going forward.
All right. So various suggestions and representations have been made by the industry to the regulatory bodies with this regard. Now, Ashley, when we talk about the level playing field between the Indian domestic investors as well as the global players, where do we stand on that front?
So I think, there have been some questions around, mainly from the tax side, where I think foreign investors have a little bit of an edge relative to domestic investors. And that's a conversation that, again, we've been having with the Ministry of Finance around, how do you ensure that there is no difference in taxation levels, primarily around on account of capital gains, because it is ultimately similar pools of capital. I think there are obviously certain advantages and disadvantages for both, in terms of in terms of sectoral limits, etc. I think, if you're an India fund, there are some advantages that you have relative to foreign funds. Obviously, the point that Srini was making is core, right? How do you ensure that as a regulator, I think it's important for all of us to have pools of capital, both from an investor side as well as the manager sitting in India. So how do you have a constructive set of regulations that encourages even foreign investors to come in through the AIF route? Globally, if you look at other geographies, even if funds may be based outside the country, they typically are encouraged or have benefits to come in and register as a domestic fund, and that should be the core. That how do we encourage those fund managers to set up structures that are based in India as opposed to being outside India, because the rub-off effect for that is quite large, right? There's a whole bunch of ancillary benefits from having the manager sit in India and be regulated in India versus being outside. So I think that is that should be the focal point, in terms of how do we bridge the gap there. So and if you have a regime where India funds are potentially taxed at a higher level relative to foreign funds, that does not help that cause.
Right. So you raised a very important point, and I'll throw that question up for Srini. Cost of raising money. You want to address that, Srini?
Yeah, I just add to what Ashley said, and I'll also add answer the question on cost of raising capital. We have the Atmanirbhar Bharat as an objective for us. Make in India as another objective for us. And I think to Ashley's point, what we as an industry would like to see is also manage from India, similar to Make in India. So you get capital from wherever you do, globally or otherwise, but the environment must facilitate more managers to come and manage the capital from India, because then the ecosystem benefits of all kinds of global practices comes into the picture. With regard to cost of raising capital, right now the distribution channels through which private capital is raised in India is reasonably consolidated and therefore expensive as well. And so if you were to compare it, for example, in mutual funds, currently those costs are regulated in mutual funds. There is a very broad regulation right now, but overall the cost of raising capital from the domestic market is quite high compared to some of the other markets. Over time, I'm sure that will change as competition comes in.
Right. So that's one area that needs to be addressed quite effectively. But Ashley, I can't let you go without, giving me a trend on where PE is headed at this particular point. What are the trends really picking up? You spoke about the buyout transactions, but what I also gather is that the promoter class, from confidence money to buyout, it has been a long journey. But with the valuations picking up, whether the promoters would like now to exit completely or ride with the private equity player for a later exit at a higher valuation is also one question that I throw to the PE community right now. So what are the trends that you're seeing, and what are the sectors that are really becoming the flavor of the season now?
Yeah, so just addressing your first point, I think we have seen a couple of changes that are occurring, which is leading to people moving more towards house, right? One is entrepreneurs have recognized that private equity funds do not bring only capital to the table. There is value that they bring to the table as well, and so they're seeing that and they're enjoying the benefits. Most PE firms today have a team that works on the operating side. And so we have operating folks who help create that benefit, and entrepreneurs are enjoying that benefit as well. And then the second point is, previously, entrepreneurs would not want to divest their businesses because of the next generation. We're seeing the second generation in promoter families wanting to expand and do other things. And so that has given a lot more confidence to entrepreneurs to say, look, maybe we want to sell out the business. I think one good structure of managing the bridge between the expectations of the entrepreneur in terms of their valuation versus what PE investors want to pay is to allow them to roll over a portion. And whilst the PE investor takes control, as opposed to buying 100%, maybe you buy 80% and let the entrepreneur continue to own the balance 20%. We have seen that balance 20% of the entrepreneur is far more valuable than the 80% that they've sold because of the value that the fund has added in the next 5 years.
Yes.
And so entrepreneurs are encouraged and like that, where they feel that they have not left money on the table and get the benefit from that.
Right. Yes, and okay, so that's a very interesting point you made, where a lot of private equity may not want to have the promoters part of the company once they have bought control. But finally and very quickly, key trends picking up in private equity investment in the country.
No, so I think the kind of sectors that we've been looking at are continuing to remain interesting. So I think financial services has always been interesting. On the pharma healthcare side, I think we're seeing a lot of opportunities. The India macro offers a big story from a consumption perspective. So anything that's domestic consumption, whether it's a consumer business or it is the new age digital businesses, I think are definitely very, very interesting. AI is definitely an opportunity. One may I know there are some conversations around, is AI going to threaten the overall business services business, given that it could sort of replicate what is being done. But there are contrarian reports as well saying that what is needed at the back to create the back end of the AI, and is that an opportunity for companies to be able to help create that, similar to the Y2K kind of situation many years ago.
Right.
So those are interesting opportunities that we are definitely seeing.
All right. Thank you so much, Ashley, Srini, for sharing your thoughts on investing ecosystem in the country and what lies ahead when it comes to IVCA's agenda. Thank you so much for joining us, and thanks to all our viewers for tuning in. Keep it with CNBC TV 18.